Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
This weekend's U.S. intervention in Venezuela has energy markets spinning, and global markets are reacting in real time. Could Venezuela's heavy crude threaten Canada's oil sands? Which sectors are at risk, and where might the opportunities lie? Let's dig into what Canadian investors need to know now. As a reminder today, Bipin and I are not providing any investment advice or investment recommendations. Today's show and all our shows are about investment education for Canadian investors. I'm Danielle Nezel with BMO ETFs, and joining me today is Bipin Rai, Head of ETF and Alternative Strategy at BMO Global Asset Management. Bipin is going to provide some interesting thoughts on this developing situation and provide a unique Canadian perspective on what is going on. Bipin, thank you so much for taking the time to join the channel today.
Thank you for having me, Danielle, and Happy New Year to everyone.
Yes, Happy New Year. Great to be back 2026. And first week back after vacation, Bipin, this happens over the weekend. We came rolling back into our desks on Monday thinking we would just be analyzing some ETF flows from 2025, but here we are talking about what's going on in South America. You wrote an excellent report that hit my desk. You brought up a lot of great things for Canadians to consider when we're breaking down what's going on. And I want to talk to everybody today about what you had to say. So let's start by talking about the U.S. intervention in Venezuela. It's just occurred. Markets opened on Monday. How are equity markets digesting all this news right now?
Yeah, for the most part, it feels like the broader equity markets, both in the U.S. and Canada, are taking this in stride. But if we distill it on a sectoral basis, I mean, obviously there's some residual concern in the energy sector, especially here in Canada, given the fact that if we look at the grade of crude oil that Venezuela could potentially export, and that's a big could and a big if as well, is very, very similar to the type that's extracted out of Alberta.
Dive into that a little deeper. What's at stake for Canada's oil sector? If the U.S. were to pick up investment in Venezuela and Venezuela could start exporting, could this become a real competitor for Alberta's oil sands, or are the hurdles there just too high?
So I think, it's a nuanced answer to an important question, right? So, I mean, if we look at Canada's oil sand sector as a whole, I mean, our largest customer is, of course, the United States. And anytime you have an important sector with, one major dominant customer, it does leave you vulnerable to potential supply shocks, especially of the kind that occurred over the weekend. And also remember that, yes, we do export crude oil to the United States, but remember, our crude ends up in different regions, right? So the vast, overwhelming majority of our crude actually ends up being consumed in the U.S. Midwest, or what's known as the PAD 2 region. A very, very little amount goes to the Gulf Coast, which is primarily the area of the United States that's also called PAD 3, where Venezuelan crude, if these sanctions are lifted and if we do see Venezuelan production pick up and exported, that's primarily where it's going to end up in the United States. Now, there could be some degree of concern that, over time, we could potentially see, the Venezuelan crude that ends up in that PAD 3 region in the U.S. Gulf Coast start to make its way up to the PAD 2 region. But remember also that pipelines, in the way they're configured right now, they're configured to flow from north to south. And to reverse that would take an inordinate amount of capital investment, something that, in our minds, doesn't really make much sense at this point.
Okay, so still a few ifs right there. We'll have to see how things shake out over the next weeks and months. How do you see these events potentially impacting equity markets? I know you said earlier this week equity markets were a little less affected. But if we dive down deeper, which sectors could see even a greater impact?
I mean, I think it's going to be an energy story for now. And we talk about Canada and the U.S., and obviously, that's of utmost importance to us sitting here. But remember, I mean, if we do see additional supply coming online from Venezuela, and keep in mind that crude oil reserves there are the largest in the world, then it's a global story, and potentially that does affect larger benchmarks like WTI first, and then potentially they do migrate towards Western Canada Select. You could see the discounts widen materially, but we're talking about lower energy prices writ large, right? And that doesn't just affect the energy sector on its own. The impact could be much more broad than that. There could be real economic implications at play as well. Now, if we look at the way the Bank of Canada would look at this, and I suspect that's going to be an important topic to discuss in the upcoming meetings as well. The bank does have a model that they use as part of their input into their forecasting process on a quarterly basis. And, what that model would suggest that, if we do see, say, a shock type move, where we see supply come online, prices react by moving lower, then, the bank actually places a lot of weight potentially on households using that as sort of like a tax cut and actually spending more into the real economy. So it's quite interesting. Well, the output gap could widen. At the same time, households will spend more, so that actually keeps inflationary pressures elevated relative to expectations. So there actually wouldn't be much room for the Bank of Canada to cut in that scenario. And if we're breaking it down in terms of equity sectors that could potentially do well in that sort of environment, I mean, in Canada, certainly some discretionary stocks could do well, and that would be the first place that we would look in terms of outperformance, aside from some of the other sectors that we're already quite bullish in.
What about the spot gold price? Where's that sitting now? I know gold tends to rally when there's geopolitical unrest.
Yeah, it's a good question. Let me just pull that up on my Bloomberg. It's in front of my screen right now, as luck would have it. So, over the last couple of days, we've seen some constructive moves in gold. We're currently just below 4,500. You could make the case that, on a medium term to long term basis, that, this is quite constructive for gold, because all of a sudden now we're in this sort of geopolitical environment where anything is possible. And usually in those sorts of environments, we tend to see central banks placing a little bit more weight on assets that aren't really denominated by sovereign uh, fixed income, let's call it. I mean, we have seen a migration away from U.S. Treasuries into gold as part of reserve holdings for a lot of central banks. We'd expect to see a similar pickup in that direction. In fact, we were projecting it earlier that or late last year when we were coming up with our forecast for gold prices. But that's going to be offset to a degree by the fact that, jewelry fabrication, which tends to be a fairly large source of demand for gold in any given year, that's probably going to come off a little bit given the massive price appreciation that we had last year. So again, 4,500 for now. Could that migrate up towards 47, 4,800? In our minds, yes, that feels like a fair and accurate end of year forecast for gold.
Yeah, the last time you were on the show, I think we were talking about gold and you were forecasting around 4,500 in the new year. Of course,
Yeah.
we didn't see this black swan event. It wasn't on our bingo card, as you said, but interesting that now that that's kind of a story to keep our eyes on when we're talking about the gold price. For investors who are tactical, who want to be nimble and perhaps make a market play or a trade based on events that are unfolding, how can investors think about investing in an environment like this with that tactical mindset?
Well, if we're talking tactical, and I'm assuming the time horizon there is implicitly 1 to 3 months, I think what makes sense is potentially to look at the energy space in Canada, because I do think that it's been whacked a little bit harder than might be fair at this point. There are considerable hurdles still in place to that will, let me rephrase that. There are hurdles in place that will prevent an en masse sort of ramp up in production when it comes to Venezuelan crude and exporting that to the Gulf market. I mean, if we look at the crude oil infrastructure right now in Venezuela, severely damaged. It's been like that for the better part of the last 10 to 15 years. And again, that requires a lot of capital still to be invested there, at least 100 billion or so. And that's not going to happen overnight. And the other aspect to consider here as well is the fact that you are talking about a country where crime rates are relatively elevated, and investor confidence in investing in a country like that, still might be a little bit shaky. So again, there is a degree of trust that needs to be built. There's an inordinate amount of capital that needs to be injected still, and that's also we need to consider the fact that there's still a heavy degree of sanctions in place in on Venezuela. So again, all of those need to be taken into consideration before we start to worry about what this means for the Canadian crude sector over the medium to long term. I would suspect though that in the near term, I think the reaction has been a little bit too swift relative to what we think is likely.
Great insight there, Bipin. Thanks so much for bringing that to everybody in the channel. I know we get to read your reports often, and it's great that you can share with a wider Canadian investor audience. Sounds like this is so far sticking to more of an energy sector story, but we will see how things unfold over the next weeks and months. I'm sure this isn't the last time we'll be talking about this, Bipin, but thanks for joining us to get the conversation started.
My pleasure, Danielle.
That's it for ETF Market Insights. We'll see you next week.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.